Well, a very warm welcome on behalf of the University of Amsterdam and the Amsterdam Centre for Tax Law. We're organizing this seminar together with Tax Analysts, and I hope it will be a very fruitful seminar. My name is Sjoerd. I'm a professor at the University of Amsterdam, of which, of course, I'm very proud. Hopefully we'll have a very interesting seminar. Lots of things going on. Even the day before yesterday, substantive changes already to the proposal submitted by the House of Representatives, the Republican section of it. And I even learned 5 minutes ago that the Senate might produce their own bill. But Marty will tell us all about that in a few minutes. Well, without further ado, I would like to give the microphone to Cara Griffith for a few words. I'm co-hosting the session until the break together with Cara. Great. So at 7:15 we'll have a short break. No drinks, unfortunately, but a short break to stretch the legs, and then we'll continue with a panel session after the break. But Cara, can I invite you perhaps to introduce the speakers for the plenary session before the break?
Welcome, and thank you so much for coming. We're very excited about this. It's been a whirlwind tour for us. We started 2 days ago doing very similar conferences in London. Yesterday we were in Dublin, and tomorrow we are in Milan. So it's been very exciting, quite busy, but it's really it's a lot of fun for us. So I'm Cara Griffith. I'm the CEO of Tax Analysts. For those who don't know, Tax Analysts is a nonprofit tax publisher. We publish Tax Notes as our flagship publication, but we also have Tax Notes International, State Tax Notes, and a few other dailies. We are about 45 years old, and we focus exclusively on tax. And so today, I'm thrilled. These guys do a fantastic job. I thought coming into this that I was going to moderate them and I was going to ask them all sorts of questions, and it turns out they kind of have their own show going. So, so I hope you enjoy it today. There's a ton of information, a lot that's still going on, a lot that we don't know. I'm kind of trying to put the pieces together as we go. Been in contact with folks back in the States trying to figure out what is the House doing today, when is the Senate going to release a bill, sort of what is all going on and what is the process that we can expect. And the truthful answer is we don't really know yet. But we will present the information that we have. Please feel free as they go to ask questions. A lot of what Marty is going to talk about goes into the background and the procedure on how the U.S., how a bill becomes a law in the U.S. And there's a lot of things that may be unfamiliar. Please feel free to ask questions as they go. Don't wait until the end. If you have something that's burning, please raise your hand. So without further ado, I will introduce to you, to my immediate left here is Marty Sullivan. He is the chief economist and a contributing editor with Tax Notes. He is one of our favorite authors. He brings an economics perspective, which for us is pretty unique. A lot of what we see as practitioners and lawyers, so getting a true economist perspective is fantastic. He is frequently cited in the press. Since we've been here, he was doing a press call yesterday during lunch, and so he's a wealth of resource for the U.S. journalists. And we also have Alan Granwell, who is of Counsel with Sharp Partners. He is an international tax practitioner with a lot of experience working with multinationals, and so he's going to bring a lot of technical expertise to the discussion and the debate of all of the provisions. So, without further ado, tax reform.
Thank you, Cara, very much. And thank everybody for coming today. I want to apologize in advance because it's a 450-page bill that was just released 3 days ago, and it's changing literally as we speak now. What time is it in Washington, D.C.? I think it's 10 a.m. about. So they're actually drafting the bill in the Ways and Means Committee. What I'm going to try to do today is give you an executive summary. And there are many, many details. So as much material as I'm going to throw at you, I'm only skimming the surface. And so I apologize for that, but it's the biggest change in tax law that we've ever had in 31 years in the United States. Now, big picture. what's going on in the United States? Well, we're making America great again. You probably heard about that. And MAGA. And I've been doing this for 30 years. I think, Alan, you've only been doing it for 20 years. We've never seen anything like this before, so it's very hard for us to predict what's going on. And let me tell you the many ways that it's different than it's been in the past. So the one-word summary I would say of all of this is unprecedented. We don't really understand what's going on. It's unlike anything we've ever seen before. So the first thing is we have this tremendously rushed pace. The Republicans have midterm elections in November. Everybody has in November of 2018. They have promised to repeal the Affordable Care Act, Obamacare. They did not succeed at that. Well, that's incredible that because they control the House of Representatives, they control the Senate, they control the presidency. Well, since this is your signature issue and you control the entire United States government, why haven't you achieved what you said you were going to do? So that is a major political problem for them. But they said, well, don't worry, yeah, we didn't get that, but we're going to do tax reform. So now the political pressure is even more on them to produce results. And if they don't produce results, they'll probably be out of office. It will be a political catastrophe of unprecedented proportions. Because it's not just like you don't pass a bill, you are definitely going to lose the election if this happens. So political desperation is, as they have, for 8 years they had Obama blocking everything that they did. And they got pretty comfortable in over-promising because they knew it was never going to happen. So they would promise, at one point they were promising an individual top rate of 25%. And that has, as you'll see, that's crept up from 25 to 28 to 33 to 35, and now they're actually proposing to maintain the top US rate at 39.6%, which 1 month ago would have been sacrilege for a Republican to say we were not going to cut the tax rate. Unprecedented lack of transparency. Just as they did with Obamacare, a bunch of leaders get together, they go into a room for 4 or 5 months, they get nothing done, and they come out with an executive summary, and then they draft it in about 1 day, and then even members of their own party, they don't release it to them. And so experts like ourselves don't have time to really evaluate it on a technical level. Members of politicians don't have time to evaluate it on a political level. They're trying to rush it through because the longer it lays, longer it's subject to scrutiny, the more likely it is going to fail. Heightened partisanship. Our Great Tax Reform Act of 1986, Ronald Reagan was president, and the Democrats were in control of the House, the lower chamber. The Republicans were in control of the Senate, the upper chamber. And people we thought we were fighting back then, but we had friendly disagreements. Now it is just, if you don't agree with somebody, they're your enemy. It's just the partisanship has just gone way out of proportion. So it's very hard for the parties to work together at all, as they did in 1986. In 1986, it was a bipartisan bill. And that's very important. It's not just, it's nice that we all get along. If this bill does pass, and it's only on a partisan basis with only Republican support, when the Democrats get in power, sooner or later the Democrats, it's going to flip back, this bill will be picked apart very quickly. So the longevity of a bill, the durability of a bill is much better, much longer if it's bipartisan. And we're very unlikely to have that happen. Unprecedented, we have a new way of doing revenue estimates, which are very critical, as you'll see. I used to be a revenue estimator when I worked for the US Congress. And what they used to do is they'd say, well, we're going to give you a $100 deduction, you have a 20% tax rate, so therefore your taxes go down $20. That would be what the revenue estimate would reflect. Now, with so-called dynamic estimates, they're going to say, oh, we're going to give you a $100 deduction, you have a 20% rate, your taxes went down 20%, and now I'm going to work more, and now I'm going to save more, and this is going to create economic growth. And that economic growth is going to increase revenues, so the cost of that deduction is not really 20, it's something lesser than 20. And the Republicans are counting on this because, like all politicians, they don't want to inflict pain. So, but it's turning out not to be that, it's not going to be important in the process, but it's going to be very important in their rhetoric, because the dynamic scoring is not turning out to be very, it's not turning out to be significant. And then finally, substantially reduced fiscal space. I love that term fiscal space. It just means we got a lot of debt. And this chart shows the annual deficits for the US from 1967 to that vertical line is the present. So every year, it's like a little walk down memory lane. When we hit the 1980s, Ronald Reagan came to power. He had big tax cuts, and our deficits went up. And we had a recession. And then we had tax increases from, read my lips, George Bush. I was not raising taxes in 1990. 1993, Bill Clinton comes in, he raises taxes. And then we had the dot-com boom in the late 1990s. Economic growth was through the roof. Bill Clinton takes credit for the reduction in the deficit, but really it was just the economy was booming, nothing really to do with government. Then we go into, when Bill Clinton leaves office and George Bush II comes to power, our deficit projections were that our debt was going to be eliminated. So I'm a Republican, I like tax cuts, the debt is going away, definitely, why not? So that's what happened. Then we had the wars and so forth, and then the deficits came back. And then of course we had the financial crisis of 2008, and our deficit went to unprecedented levels. When I was, in ancient times when I was working on the Hill, when the deficits were at 3%, we were, oh my God, the world's coming to an end. Well, the world did come to an end because this is sort of the same picture in a different way. This is the ratio of the federal debt, the stock of debt, to GDP. And you can, it's just the same pattern. We have the Reagan Tax Cuts in 1981, increasing the debt, the dot-com boom, reducing the debt, the incredible doubling of our debt in 3 years because of the financial crisis. We went from 35 to over 70. So now we're at 77% debt to GDP. Unprecedented, the reason why we're saying unprecedented, if you think about 1981 with the Reagan tax cuts, which the Republicans often cite, well, we had a 25% debt to GDP ratio. We weren't playing with fire. When George Bush did his tax cuts in 2001, again, the deficit, that was projected to go to zero. So it was not a major concern. We're at 77% now, and we're not going anywhere but north because of the aging population, increasing government expenditures on medical care and on Social Security. So we're not in a very good fiscal shape in the United States. So as you might say to yourself, why are we cutting taxes at a time when we're heading in this direction? And the simple answer is the Republicans, that's their brand, it's in their DNA, it's what they've been promising for 8 years, they have to deliver. So as I rapidly go through all of this, this slide describes the process. And you may not be familiar, so I'll walk you through it. On the left side is a verbal description of the process. On the right side is what President Trump says is going to happen. I only can vouch for the left side in terms of what will happen. The first thing we had to do, it sounds like a detail, but it's extremely important if you're trying to follow it, is we had to, the Republicans had to get reconciliation. It's a technical term in the budget process. And the reason why that's so important is that usually in the US Senate, under the rules of the US Senate, you need to have 60 votes to get passage. And of course, the Republicans only have 52 votes. So, but under reconciliation procedures, it's a special exception to the rule, they only need 50 votes. So they spent about 6 months just getting to the starting line, if you will. So everything you've been hearing up to this point has pretty much been prelude to the real event. And the real event started on November 2nd. This is when we really started making tax law. And where that happens is we have the House and the Senate, and in the House, the Tax Writing Committee is the Ways and Means Committee, and the usual procedure is the chairman puts out his draft of the bill. They call it his mark. And so that was the 450-page statutory draft that was released. I know you've all read it, so I won't have to go through that. Tell me what's in it now. And then right now, as we are speaking, we're on that third line. The Ways and Means Committee is actually, members are offering amendments, and pretty much right now, they're being voted down on party lines. That is, the Republicans are prevailing, which is normal in the House. In the House, if you have a majority, it's the minority can really not do much about it. So, since the Republicans do have 239, which is you only need 216 right now to have a majority, they are firmly in control of the House. So we're on stage 3, which began now. I think it's future. Began on November 6th and is going on right now. It is scheduled to end tomorrow. It'll probably be pretty much. There's some important changes that have taken place, but it'll be pretty much, in the big picture, be the same bill that was approved, that was introduced on November 6th. Then it has to go to the full House of Representatives, where they only need a simple majority, 216 votes. They have 239 Republicans. So that should go through because no amendments are really allowed in the House. But then when we hit that point, which may be as soon as a week from now, if you believe the optimistic Republican schedule for this, then we have 4 other places where the bill can change very significantly. Okay, so even when we get to that stage, you think, oh, no, it's not even close to being over yet. Because then we have the same process taking place in the Senate, but in the Senate rules, there's much more flexibility for members to have input from both parties. So we'll go to the Senate Finance Committee. Senator Orrin Hatch of Utah is the chairman of that committee. He'll put out his mark. He'll put out his bill. It will be a different bill with different priorities. He's a Republican, so it'll have the same general thrust, but the details will be very different. Then, in the committee, unlike the Ways and Means Committee, there's much more back and forth, much more give and take between the parties. So the bill that the Senator Hatch will introduce may be significantly amended in committee. Then it will come out of the committee, and then it will go to the Senate floor. Okay, that was stage 3. So go to the Senate floor, that's stage 4, where all 100 members of the Senate can offer amendments, and they have give and take, and they can be changed then. So then, after stage 4, now we have a House bill, and we have a Senate bill, and they're going to be very different. So how do we make the law? We go to we call conference committee, where the senior members of the House and the Senate get together, and they try to reconcile the differences. Well, these bills are going to be very different, even though they're members of the same party, they're going to be very different. At that stage 5, you may have more significant changes. So you don't have to expect a lot of change. And then still on top of that, we go to both the House and the Senate have to approve the conference bill. And then the president, well, he'll sign anything, so don't worry. We're not worried about that. And it's a lot to throw at you. I don't know how familiar you are with the U.S. process. Yes, sir.
It's more a political question than a tax question, but there are special elections ongoing in some states.
Yes.
Is there any impact on all of this?
I'm sorry?
Is there any impact on those elections on
Yes.
on the tax?
Yes. Yesterday we had special elections in New Jersey and in Virginia, and the Democrats won both of them. So that's sort of, as an old part, whenever you have a special election, it's sort of an indicator of how the current regime is doing. So Democrat winning New Jersey is not surprising, but it was a close race in Virginia, so that would be a little indication that Mr. Trump is not popular as he was. Right now, when Ronald Reagan was president and he began his tax reform process, he had an approval rating of over 60%. Right now, Mr. Trump has an approval rating below 35%.
It's interesting that, was it a month ago, there was an election preliminary election in Alabama, and the candidate Trump was pushing loss to this crazy guy, Judge Boer, who now is running against a Democrat to fill the seat of that was held by Jeff Sessions, who is the Attorney General, and as Marty will explain, if Moore wins, who knows what he's going to do in terms of the vote in the Senate. And then with this Virginia vote, Trump has lost twice, and Trump was backing the fellow in Virginia. So.
And Alan's not, he's a careful lawyer. He's not one to throw around a word like crazy lightly. But this guy is really crazy. He wears a cowboy hat, he carries a gun. We're not exaggerating here when we use these loose terms. We're not trying to be partisan. We're just trying to be factual. Okay.
Marty,
Oh yes.
just to understand, these wins reduce effectively that impacts the Senate as such directly.
And yes, the wins don't, not these wins, but as Marty will explain, in the Senate, it's like you only have two, you can only lose two people. We'll go through that, but I mean, it shows maybe a trend because the election is occurring November 2018, where all the members of the House of Representatives and 33 members of the Senate will be up. And this may be an indication of what is to come, but Marty will go through sort of the numbers, we'll chat about them. Makes life very interesting.
Oh, there's lots of good stories in here. Okay, we have to talk about the tax law a little bit, I guess. This is the first 300 pages of the bill on one slide. I've left out a few details, but I've tried to give you the highlights so that you won't be, something big won't come up that you won't be surprised about, you wouldn't be surprised. So just very briefly, we have 7 tax rates, graduated tax rates in the United States right now. Originally, the Republicans were talking about going to 3 rates, 12, 25, and 35. They've added a 4th rate, 39.6, which is our current rate, top rate. Now this is extremely politically significant because the Republican brand is we're going to cut taxes. And one of the most, as you know, when the press covers taxes, tax rates are kind of the only thing they can concentrate on and maybe some other simple deductions. So that's sort of the flagship of the individual tax reform, and they're maintaining the 39.6 rate, which even a month ago was unthinkable. And what this is an indication of is the rising populist mood in the Republican Party. Just, I think it's throughout the world, you see the traditional pro-business Republicans being challenged by the more populist Republicans. Mr. Trump being on the populist end of the spectrum. The members of for example, Senator Hatch of Utah would be more of a traditional Republican. So the party is splitting apart. You may have heard about this. And this 39.6% is to deflect the criticism that they're giving a tax cut to the rich. Okay, the next bullet is very important. I mean, probably none of your clients care about this, I'm pretty sure. We're talking about low-income tax, individual taxpayers. But politically, this is a firestorm right now because it's not liberals who have said you have to cut taxes for the middle class. The Republicans have said over and over again, both the House, the Senate leadership, and the President, that we're going to provide a middle-class tax cut. And the numbers have just come out the other day, and people who are making between $20,000 and $40,000, that's lower middle class, are going to experience a tax increase. So this is a political, they have been promising, it's soundbite after soundbite after soundbite, this is a middle class tax cut, and it turns out it's not. So there's a lot of, right now as we speak, there are a lot going on. I won't just quickly mention, question.
Yes, question. So there's a lot of discussion here in Europe about shifting the tax burden to capital and less to employment. It has a discussion being done in the US whatsoever, or just?
Yeah, the question is about shifting from capital to labor.
Right.
And here, in the US, I'll get to the next slide because that's on the business and I'll directly address that. That's a good question. They're going to get, okay, this is a tax cut for the middle class. We're going to get rid of the estate tax, which only applies to people with over $10 million in assets. So it doesn't really affect most middle class tax people, at least the ones that I know. And then we're going to, the repeal of the state and local deduction, just so you know, that's a huge political issue. I won't go into it now. But people from high tax states like my home state, New Jersey, New York, and California are very angry about not being able to deduct their local taxes from their federal tax returns. Okay, business provisions.
Can I ask one more question?
Certainly.
One of the thorns in the feet of Americans living abroad is that they still have to pay US taxes. And there was a hope that with system change in the US that might be repealed.
So
I don't see it on the slide.
I didn't forget it, it's because it's not there.
I was afraid of that.
No, but it's a very good and very important question. There are 9 million Americans living outside of the United States, 4.5 million taxpayers outside of the United States. And Alan, you have a...
Yeah, no, we have it in the slides, which you don't have a copy of. And essentially, and this came out the last day or so, it's not in the bill of the House. We'll see if it's in the Senate bill, but the opponents, the supporters of that concept to go to a residence as opposed to a worldwide basis had retained an economic consulting firm to do a revenue analysis. And there was something, I think, in your publication yesterday and today, saying that if you move to a territorial system, so to speak, or a residence-based system, it wouldn't lose revenue. So there are two items, I mean, there are probably more, but which may come up later, and that is this business we're talking about with the residence for individuals, which would be a major change, and you can go into that if you want. And the second one, there's a possibility during the conference committee that gets that far, that there may be a resolution to repeal FATCA, Foreign Account Tax Compliance Act. We don't know if that's going to happen, but you have to stay alert. But both of these things could happen because this one, and I've been very involved with that first one, it's a big mess for U.S. persons living here, or people who might have been born in the States and then 2 months later moved back to the Netherlands, never knew they were Americans, and now are significant non-compliance.
But my shorthand way of thinking about it is territory. We're going to go to a territorial system for companies. Why don't we go to a territorial system for individuals? And there is not much, but there is among the members of Congress who support changing that system. They're very vehement about it, but they're not in the, there were Republicans, they're in the majority, but there's not a majority of Republicans who are really pushing that. But it may surface. But as you'll see, the money is a little tight, so we're going to have to inflict pain. And since they're already in pain, and they're 3,000 miles away, maybe I don't. But it's a very good question because it does keep coming up, and it may percolate to the surface. But again, it's the money. It's not the sentiment. It's just I'd love to buy you a Mercedes-Benz, but I just don't have the cash. So here we go. I originally had 63 bullet points, but Alan made me cut them out. So I had to winnie it down to 6. And this is so making sure you don't miss some of the big facts. Okay, just a few months ago, all of the Republican leaders and the president said we wanted a revenue neutral reform so we wouldn't worsen our horrible debt and deficit situation. Well, yeah, you have winners and losers, and you have an equal numbers of winners and losers. It's very hard to be a good politician in that case. So when they did budget reconciliation, that technical thing, they sort of changed it to a $1.5 trillion tax cut. And their claim is that, don't worry, we're going to have so much economic growth that it will pay for itself, so don't worry about this $1.5 trillion over 10 years. That has not been supported by many economists, but if you're a senator, you don't have to pay attention to economists. And nobody has to pay attention.
To the point the gentleman asked about wages and capital and who's going to benefit.
Oh, that's right. I'm so sorry.
No more.
That's okay. There's definitely an understanding in the United States, and it's changed dramatically, that we need to stop taxing businesses which are mobile. And if we want to tax, we have a double tax on our corporate profits. We should tax at the individual level because they're less mobile. And so there is a universal agreement that we need to reduce our corporate tax to reduce profit shifting and to increase economic growth in the United States. And we're so far out of line with the rest of the world now. So there is that trend. There is that recognition. So if you that we need to push more of the tax burden onto the wealthy. Now that's not really getting to the wages. But so again, it's the split between the Republican Party, and I'll keep coming back to it because I think it's central. You have your traditional pro-business folks that say cut taxes, and within that group, what I just described has taken place. There's a recognition we need to focus on not tax, because George Bush, both Bushes, cut taxes on individual capital gains and dividends because they wanted to create, and they realize now that that was exactly the wrong move if you have limited options. What you should have done is raise taxes on the individuals and cut taxes on the corporations. But corporations don't vote, and here we go. So I think...
Marty, but doesn't it go to the economic debate by Hassard, who's the chair of the Council of Economic Advisors, that if you cut the rate to 20%, that's going to increase investment, and the investment will mean hiring people, and you get higher wages, and da-da-da.
Right, I forgot the economics, that's right.
If I have to talk about it, we're in big trouble.
No, I think you express it much better than the president does.
That's a big low bar.
No, the claim you're going to hear over and over and over again is the press will ask the Republicans, now you said you're going to cut taxes for the middle class. Can you promise us that you're going to cut taxes for the middle class? And their answer is, it's kind of a lawyer answer, right? They say, everybody will be better off under this bill. And what they're saying is, and Alan's referring to one of Trump's chief economists, Kevin Hassett, who is a respected economist, but as you know, we economists, we have a wide spectrum of views, so you always find an economist who will give you the answer that you want. And because there's so much uncertainty, not because we're... No, never mind.
Don't go there.
Don't go there, right. So anyway, the claim is that there's going to be so much wage, we're going to have so much more capital. So you have to, actually, it's a three-step process. It's really interesting, and all three steps have to take place, and they really have not been proven definitively. The first thing is that taxes are going to actually increase capital formation, 1. 2, that capital formation is going to increase worker productivity, 2. And 3, that productivity is going to translate into higher wages, 3. If all three of those steps take place. Now, when you hear a politician say it, they go, oh, corporate tax cuts are going to increase wages. They don't break it down into those component parts. So their political answer is, well, we're going to cut taxes for corporations, but don't worry about it, your wages are going to go up. And I don't think, I think it's a great soundbite, but I don't think the American public's going to buy it, because if your taxes go up, 5 years later, maybe your employer is going to increase your wages. I don't think that's going to fly politically. Moving, okay, did I do everything? Oh, no. Okay, the other important thing you have to know, if you want to be conversant with Americans, and I wouldn't blame you if you didn't want to, we have a $1.5 trillion tax cut. That is allowed. Not $1 more, or you violate the reconciliation procedures and the whole thing goes down the tubes. You also, under these, what's called the Byrd Rule, named after a esteemed former Budget Committee chairman, you can't have any revenue losses after 10 years, which means something has to give. You have to let some of those tax cuts expire. And these are estimates, so these are not what actually happens. So, so you're going to see a lot of expiring provisions in the bill. The same thing happened in 2001. When George Bush cut individual taxes, they were only 10 years and then they expired. And then Congress has to reconsider them again. And that's a can of worms. So that's the Byrd Rule. Yes? Pardon? Yes, question? No.
Can I just, are you saying that this 1.5 trillion, basically, who is making these calculations? I guess it's an independent, I understood it's independent.
Yes, the question is who does the calculations, and the official estimator is the Joint Committee on Taxation, which is a congressional, nonpartisan, highly respected organization. I used to work for them. I actually used to do estimates. I wasn't highly respected, the organization, and and they really do. Most of what you hear in the press is from private partisan groups, because they they're very skillful at putting out the numbers. But the Joint Committee is very quiet. They don't have a press release in the communications department and all that. But it's their numbers who count. Now, there's something that very few people know, is that although the Joint Committee has always been the official estimator, under these procedures, the chairman of the Budget Committee, Senator Enzi of Idaho, someplace out there, and he can overrule, he can just say, the Joint Committee might say, that cost $200 million. He'd go, no, I think it's 7. And he can say anything he wants. And he has that authority to do that now. It's never been done, but statutorily he has that authority. So why would I bring it up if it's never been done? Because we're in an unprecedented time. If the Republicans are going to lose power, and because I said the estimate was 200 million, and it pushes them over that $1.5 trillion limit, I don't think they're going to care too much about precedent anymore, because we're in an unprecedented situation.
Isn't it also the case, Marty, on the business changes, the rates going down from 35 to 20, and the president said, that 20% business is non-negotiable. And didn't something happen today, a rumor in the Senate about that particular?
Absolutely, Alan. Thanks for reminding me. Today, usually the process that I laid out for you happens in sequence. We go to the House, and we do all the House stuff, and then we go to the Senate, we do all the Senate stuff. But of course, they're so pressed for time, they're going to start doing the Senate bill before they finish the House bill, which is, I don't know what the lobbyists are going to do. They have to keep running on both sides of the Capitol at the same time. It's going to be very difficult. So, but the Senate may tomorrow, even though we're still in the middle of the House process, release the Senate chairman, Senator Hatch, will release his version, which will be different. And the rumors now are that he's going to retain the 7 rates. Remember, I had 4 rates up there. We have 7 rates now. He's going to retain those 7 rates, and he's going to delay the corporate tax cut for 1 year from 35. The corporate rate's going from 35 to 20. The president and the Republicans are very keen for that to happen, and the business community are very keen for that to happen right away. But to save money in this all-important $1.5 trillion budget constraint, they're going to just delay it for a year. So things like, and that's just the tip of the iceberg. We expect many changes if it comes out tomorrow. Or if I check my cell phone, I'm not being rude. I'm actually checking to make sure what I'm saying is still true, because they may be leaks coming out right now.
I think the point being, and I know there's a question, and Marty can explain this with great clarity, but $1.5 trillion is the estimate which the bill can't exceed, otherwise you have 60 votes in the Senate, which it ain't gonna pass. But there are a number of techniques, or what Marty would call gimmicks, to stay within the $1.5 trillion. One of these being you delay the date because you're then not losing revenue in the first year, where you sunset and things terminate within 10 years or others. So there are a lot of these things which will be occurring over the next few weeks.
Absolutely, it's you can't emphasize it. You can't emphasize it enough. It's happening very quickly. This is another overview of the bill. Just looking at the revenue, and if you divide the bill into 3 parts: tax cuts for individuals, tax cuts for businesses, and tax cuts for the international sector, if you will. Individuals get a $4 trillion tax cut, but they have to find $3 trillion of revenue raisers, inflict $3 trillion of pain to pay for those tax cuts. On the business side, and just looking at U.S. domestic business, $1.5 trillion of tax cuts. That's mostly the 35 to 20% rate, offset by a lot of base broadening, the elimination of dozens of deductions and credits that we don't have time to go into that will be eliminated. And so the net cut for businesses is that blue line, 843. So you see 929, 843, that sounds about even, but it's really not even, because the business corporate sector only pays about 1/10 the amount of tax that the individual sector pays. So in terms of proportion and percentage, the tax cuts for businesses are proportionately much larger. And that's unprecedented in the history of U.S. tax cuts. I found this out. And go ahead. Sorry.
No, please finish your sentence.
No, okay.
I had understood that in the change over to a territorial system, the sweetener for the loss of revenue would be the fact that there would be a one-off charge on all the non-repatriated foreign
We'll be
income.
talking about that.
You are going to talk about that?
Yes.
Oh, yes.
Okay.
We're saving the best for the end.
I'll withhold my question.
Withhold your question.
Hold that, but please ask it again if we don't do an adequate job. And
But I was wondering
Yeah.
how that
let's go to the next slide.
spikes out.
Yeah.
Okay.
The foreign piece is very interesting, and obviously for people like us, it's a prime interest. You see a $224 billion tax cut. That's mostly the move to a territorial system. Then you see half $500 billion of tax increases. And I'm going to break that down in the next slide. So the international sector, so even though this is a very pro-business bill, from that middle part, for international business, both inbound into the United States and outbound from the United States to other countries, it's very bad. On net, if you're Apple or whatever company, you have to weigh whether that 35 to 20 offsets the tight toughening of the international tax rules. And very quickly, I have 1 more minute left, and I'm going to use all 60 seconds of it. That international piece, in my simple economic mind, I break it down into 5 big parts. We're moving to a territorial system that's a $200 billion tax cut over 10 years. There's the repatriation piece. If it's cash, somehow defined, and that's very, I thought that was an easy thing, but no, it's very complicated. That's 12% if you bring it back. And it's not voluntary, it's going to be taxed one way or the other. So you no longer have trapped foreign profits, but we're going to tax in. So you can keep them offshore, you bring them home, do whatever you want, but we're still going to tax that stock of accumulated earnings, which now is approaching $3 trillion. We're going to tax the cash portion at 12%, and the other portion invested in plant and equipment and maybe other businesses at 5%. And that's a large revenue raiser, 223 billion. And then we expected to have something like a minimum tax. And you're going to explain that, so I won't go through that right now, but it's very important. And we have two sets of interest limitations. One like the Italians and the Germans have, the 30% of cash flow. I can't say. Yeah, I can't say. So, and then we also have another interest allocation rule, sort of a formulary approach to allocating interest. And all of this is designed to prevent profit shifting, which has got, it used to be a secret, and now it's common knowledge all over town. And then we have, drum roll please, big excitement, nobody expected it, nobody can quite understand what it is, but Alan will explain it, the 20% excise tax. This came out of the blue. Nobody, and it's, as you can see, it's a big portion of the revenue raising here. Now this estimate, somebody leaked an estimate to us, and they've modified it, and Alan's going to talk about it a lot. The estimate has gone down to like 50 million. It's gone down a great deal because they realized it was too severe. It's in flux. It's in total flux right now. It's very controversial, and that's why I'm going to hand the microphone to
Marty, just one
Yes, question.
Yeah, the 223 in the second column.
Yes.
That is the mandatory repatriation
Yes.
as of day one. So if that is against 10%, the amount of offshore earnings that will be deemed repatriated is about a bit over 2 trillion.
10%, let's do our math. 10% of 3 trillion is 300 billion.
Right? No, but the repatriation is 223.
Right.
So let's say that that's 10%. Well,
It's 5.
It's in fact 5 and 12, but let's assume that this is all cash equivalent.
Okay.
So it's it's slightly over 2.5 trillion or something. And that's for a 10-year period.
That's
So
you get to bring it back over.
sorry.
You pay the tax.
This is once. This is the one. Yeah.
It's the existing stock of accumulated earnings and profits, somehow defined.
Right.
And
if you then go back to the first column, so the cost of the switch to territorial, and that's for a 10-year period. So that tells you how successful deferral has been in the past.
Yes.
That number, should probably have been, I don't know, 3 trillion? Or,
yeah, right, exactly. And one of the shocking things to the business community was the first revenue estimate they actually did on territorial was it raised revenue. It actually tightened the system. And as experienced practitioners know, nobody has a pure territorial system. You have the Canadians you have to be a treaty partner, and the Japanese have some sort of minimum tax. My Japanese is a little rusty. And so yeah, that's exactly right. The territorial system does not pick up. It can actually lose money.
Okay, we're going to talk about these 5.
Use the microphone, because otherwise.
Yeah, I'm sorry. We're going to talk about these 5 provisions. I'm going the right way. No, I'm going backwards. Okay.
It is backwards.
A lot of what I'm going to say is backwards. The unified framework, which came out in late December in the international area, listed these 4 categories: territorial, deemed repatriation, prevention of profit shifting, and level playing field. And we're going to talk just about these. There are 5 changes. There are in the bill so far many other international changes. A number of them having to do with our CFC or Subpart F rules, which we really don't have time to consider. But one of them I just raised because if you've been looking at this or represent foreign U.S. groups, you might have said, what is this about? And just to show you the confusion that exists, there's, under our Subpart F rules, you cannot have, today, you cannot have attribution from a foreign person to a U.S. person to cause the foreign entity to be a controlled foreign corporation. It does not exist, though for some of the crazy forms we have to file, it does exist. And I don't have time to go into that. There is an amendment saying that, and then we have 3 types of ownership: direct, indirect, and what we call constructive. And what one of the proposals says is for constructive ownership, if you have a foreign owner owning stock in a Dutch company, today you can't attribute that ownership to the U.S. sub. Tomorrow you can. And when I read that, I said, okay, what is that going to do? Because under our Subpart F, you only have taxation of the U.S. shareholder if you have a direct or indirect ownership greater than 10%. And I spoke to some of my colleagues, and we all couldn't figure out what this does. And we still can't figure that out. And looking at the various reports, we can't figure it out. Obviously, if the U.S. company owned some stock, it would increase it and you could have tax. But no one, to my knowledge, has figured out exactly what this thing is all about. It may have be some anti-abuse rule to some under planning to cause tax. So you have these sorts of minor confusions, but we don't have time to deal with all of that stuff. We call it a shift to partial territorial because, and you know territorial a lot better than we do, but generally you're taxing your home country profits or earnings, and you're not taxing your profits or earnings outside of the United States. Under the system that we will be having, in order to achieve a repatriation of a dividend from a foreign company to a U.S. corporate shareholder that owns 10% or more of the stock, which is the threshold, and that dividend can come back for free, which is different than today's rule where we have this lockout effect. You have to meet the various thresholds, which I think are very key. One, we continue with our Subpart F rules with some minor modifications. So if you run afoul of our Subpart F, that money is coming back right away. Secondly, as we will see, if you run afoul of our minimum tax, that money is coming back under a Subpart F paradigm. Third, if you run afoul of one of our base erosion rules, this excise tax, then that money is subject to U.S. tax. So why do we call it partial territorial? Because it's not pure. You have these various provisions which will prevent the income of the foreign company from being not subject to tax and will be immediately taxed. And as I was saying today, we have the worldwide taxation of U.S. companies. If you have income earned by a foreign company owned by a U.S. person, that generally is not subject to tax, subject to our anti-deferral rules of CFC and PFIC dealing with passive income. So we are eliminating the deferral rules for this territorial rule, but the territorial rule doesn't seem to really be what you think it is. Now, to make things more complicated, the territorial concept will not apply to individuals or pass-through entities. So if I were to own a Dutch company, I'm under the rules I have now. they're interesting planning things which the next hour we'll talk about with all of this. But we have different systems for corporates and different systems for non-corporates. Okay, so that's that one, unless there are any questions. The next one is the deemed repatriation. And again, as Marty and I think you understand, you have all this money sitting out here. U.S. companies want to bring it back at a lower rate. You know, there's the hope that when they bring it back, the money will go for investment, and maybe you can give your experience, Marty, about what the money has gone to.
As everybody will recall, in 2004, we had wasn't a deemed or mandatory repatriation, it was a voluntary repatriation. And at the time, if you were following the politics of it, all the multinationals said, give us this holiday for 14 months, and we will create so many, you know, sort of a Trumpian, we're going to create so many jobs, the economy will boom. And it wasn't hard to check afterwards whether they actually created jobs. And most of the money went to share buybacks and paying dividends and retiring debt. Not that there's anything wrong with that, but it wasn't exactly. And actually, some companies actually cut jobs right after that. Embarrassing. But the overwhelming economic evidence, both theoretical and empirical, suggests that this will not be the job creation. It sounds so wonderful to say, we're going to bring $3 trillion back and all that money is going to be invested in the United States. But most of these firms, especially the pharmaceuticals and the tech companies, are already so cash rich, there's nothing restraining them from investing in the United States if they want to. So that's the theoretical. So it's a very powerful political point. It is a very weak economic point.
Now, technically, there's a lot of planning opportunity in this provision because the amounts that are coming back are for tax years beginning after December 31st, 1986, determined as of two dates. November 2nd, 2017 is when the tax bill was released by the House Ways and Means Committee, or December 31st, the end of this year, whichever amount is greater. And these two dates were put in to prevent gaming between November and December. And taxpayers then can pick it up either in one chunk or at an election over 8 years. And the rate will either be the 12% on cash or cash equivalents, or 5% if the funds have been reinvested in stock of other entities or property or equipment. And there will be prior foreign tax credit carry forwards available, plus the foreign tax credits imposed on the deemed repatriation, particularly the withholding tax, unless you have a zero rate under a treaty. Now, the planning is really in the earnings and profits determinations if companies have positive profits or deficits, and the professional services firms are gearing up to do E&P studies for all these multinationals that have large chunks of cash abroad to maximize or minimize the U.S. tax and get things in the right box. And obviously we don't have time to talk about all of that, but that's the big deal about this thing. You will have this one-time deeming return, but then you actually have to bring the cash back. You'll have a withholding tax, generally speaking. The other point I would mention, this repatriation rule not only applies to corporations, but also to all U.S. shareholders, so to individuals and pass-throughs, even though you're not under the territorial system. And it's just one of these weird things. But this is a big deal, and as I said, our friends in the professional services firms, after the FATCA stuff they've done, are now gearing up for this. Okay.
Can I ask you a question? Sorry.
Please.
And sorry for being slow, because it's not familiar to me, but...
It's not familiar to me either.
So you have the foreign tax credit. Normally when you do a repatriation, you can credit your tax for foreign pay. So if you have 12%, is that tax credit is gone then?
They prorate it. So
Okay.
you'll get 12,
the US rate is 35, you'll get 12/35ths of the foreign tax.
Okay.
Now,
Is that right?
right, I mean, I think the other point, just to make, under our basic territorial system, and you guys know this better, you no longer will have foreign tax credits because it's exempt income. And what they did, we have two tax credit systems, direct credits and indirect credits to pick up the income of a foreign company. The rule dealing with distributions normally from a foreign company to a U.S. company will be repealed because you're under this exemption, and the deemed paid credits under subpart F will be retained. I mean, it's sort of a technical point, but credits will continue to be important, and credits have been one of the more complex things in U.S. tax planning. So we're now on this minimum tax, and this one says, there's been a lot of difficulty in figuring out you can move intangibles offshore from the U.S., and how do you attribute the return? And what this does is to say that assuming you have a foreign company and you don't have subpart F income, if you've put that money into a tax-efficient jurisdiction, a nice way of saying it, or a tax haven, maybe a lesser nice way, or a zero tax jurisdiction, you will be required as a U.S. shareholder, both corporates and individuals, this one applies to both, to pick up excess returns over a certain return on tangible property. There's a safe haven for that, and there's more detail, but suffice it for our purposes, if you, as an American, can get an intangible offshore or have it developed offshore, either way, and that earns income. And let me use the case of Ireland and then maybe contrast it to the Netherlands, or we can talk about the second part later. But let's do Ireland for a specific reason. I set up an Irish company, an intangible is developed there. And as a result, the Irish company earns $100. And there are issues about how do you determine that, which we're not going to go into. I'm not sure what the answer is at this point. Under this, and it's not subpart F income, you license something to an unrelated person. 50% of the $100 will be subject to tax under this minimum return because we don't have any tangible property. We don't have a factory, and we don't have any deemed returns, and the rate will be 20%. So that's $10. Comes back as subpart F income. The provision says you can credit 80% of the foreign taxes imposed on that distribution, which is a haircut of 20%. Well, if you're in Ireland and the amount has been subject to tax at a 12.5% rate, even with my simple math, 12.5 times 80 equals 10. So the mid-level for all of this is being in Ireland. If you have a higher rate, that will cause excess credits. Now, the other point to make about this provision, even if you own 100 CFCs, the way it's intended to work is you aggregate whatever the effective rate is, and how you do that I really don't understand yet. And if it is over, and you apply the foreign tax credits of all the countries, and if you don't meet if the credits sort of are higher, or you have, then you won't have any residual tax. So you're not doing this on a separate company basis, but you're doing this on an aggregated basis of all the CFCs you earn or you own. So the impact may not be that great. Multinationals are very unhappy about this because this is a new thing. Under old law, it was either subpart F or not subpart F. Deferral under new law, you have this other hit. So it's something they're not happy with, and I think it will create great computational difficulties in determining the base, the return, and things like that. Any questions on this one? Okay, the next one I'm not going to spend a lot of time on because I think you're probably familiar with the various proposals on interest limitations, and as Marty said, there's either the standard thing under new law of 30% of adjusted taxable income or EBITDA, or 110% of the U.S. company's share of, there's a new concept we have, International Foreign Reporting Group, which is basically either a U.S. headquartered or a foreign headquartered group, depending on ownership, which again I don't want to get into. And this is meant to level the playing field. Consolidated group members in the U.S. are treated as one company, and this 110% share of the IFRG's global earnings before interest, taxes, depreciation, and amortization is the second standard. And so instead of the earnings stripping rules we have now, which haven't been very useful, this new rule will apply. But the various reports say, recognize this applies not only to U.S. groups, but to foreign-owned groups, but also to U.S.-owned groups, and is intended to deal with the perceived abuses that have resulted from inversions and then earnings stripping. This is also intended to hopefully mitigate the complexity we have in our debt equity regulations under the Section 385. But I mean, this is again a computational thing, and you know, I think of limited interest for our discussion. The one we want to...
I presume that they pick the highest of the two.
Yes, it's the greater, absolutely, right. The one I want to spend time on is totally new, has been viewed as a real surprise, a bombshell, and I'm sure this group here has followed when the House had its what do they call it? The Better Way.
I don't know. There's been so many better ways.
They came out with a proposal in 2016 about tax reform, and they had a border adjustment tax where exports were exempt, imports were hit by a 20% levy, and there was the argument that because of the increase in the dollar, it wouldn't hit anybody. That provision was dropped, as you know, and it also violated potentially WTO and our tax treaties. Well, to level the playing field, and that's what this is all about, to prevent transfer pricing abuses, inversions, outsourcing, transfers of intangibles, offshore, base erosion. This provision provides as follows, and it has a lot of the overtones of the inbound bat. It says, and it really deals with three types of payments, but let me give you the first one, which you might find surprising. You have a something within an international financial group, so you have to come within that thing, and that means you need payments in excess of $100 million a year, which is not a problem for the big companies, but you know, takes out the smaller companies. So if you have a company in the Netherlands that's making medical equipment and is selling it to a U.S. distributor, and it could be any sort of equipment, then the amount the U.S. company paid to acquire that company, the goods, the cost of goods sold, will be subject to a 20% excise tax reduced by certain routine returns, which is an amendment that came out, unless the Dutch company elects to treat that chunk of income as what we call effectively connected with a U.S. trade or business through a permanent establishment. So that means you have a Dutch company sitting here in Rotterdam, has no connection with the U.S. You know, we don't have any, you know, we don't have a PE under Article 5, And the determination then has to be made, does the US sub of this group pay a 20% quote excise tax, which is on a gross amount, or does the Dutch company elect to be treated on ECI, as we call it, filing a net basis return? And there is, for this purpose, guidance as to how to compute the deductions, which are based on the foreign group's profitability, generally, and pay a 20% tax on the net income. Now you say, okay, you have to make that comparison. In the original brief summary, which we had sent to our panelists, I raised the question in the US, and I think you will understand this if you practice, look at US law, that not only does a foreign company pay the corporate rate on its net income, but there's something called the branch profits tax, which is a surrogate for the withholding tax, which means that if you're a foreign company sitting in the Caymans, not a treaty country, you're, on this, my example, paying 20% of 100, leaving you with 80, and then 30% of the 80, which is 24. So you're paying 24, you're not paying 20. If you're in the Netherlands, I think the branch profits tax would be at a 5% rate, so you're paying 4. So you have to compare whether paying the US company paying 20%, not getting any deduction, is better or worse than the foreign company making an ECI election, paying the regular tax and the branch profits tax. And obviously you have all the crazy returns, you have all sorts of new returns to support all of this. Now, the way this was originally formulated, the foreign company, if it made the ECI election, couldn't get a foreign tax credit. So you would have double tax.
That was on 3 days ago.
That was 3 days ago. Then 2 days ago, there was an amendment which came out saying, it talked about the routine returns in determining the excise tax. It talked about how you determine the deemed deductions, which again, is not important for this today. But it enabled you to get a foreign tax credit to prevent double tax, but it wasn't a full foreign tax credit. And as I understand what all of this is about, there are two limitations. Either you pay the lesser of 20%, you get a credit equal to 20% of what you pay, for the foreign tax that you paid, or you get a credit of 50% of the IFRG's group average tax liability, something like that. So you can imagine the computations you're going to have to go through. And what is curious about all of this, Marty said, it dropped the revenue estimate from whatever the number was to...
Yeah, the revenue estimators, it was, my slide's out of date, it said about $150 billion would be picked up by this new 20% excise tax. Under the leaked, it's an unpublished preliminary estimate, the economists think this is allowing the foreign tax credit against this excise tax would significantly reduce its effect. But all of the attorneys I speak to think it has doesn't.
Yeah,
the economists have it wrong.
And there have been in the tax press, some of my buddies in Washington have commented. They said this will help, but won't alleviate the hurt. Now, this particular provision, the multinationals really have been in violent opposition, including big players like the Koch group, which would be behind the 20%. And you have certain limited exceptions for services which are not marked up, I think cost transactions, for various commodities, for some other publicly traded things, but basically it applies on the cost of, if you buy goods. I'm just doing a renewal of an APA, and my client, who happens to be in Sweden, is giving, is licensing intangible property to their U.S. sub. Well, and this kicks in years beginning after 2018. Well, if this thing happens, then they will have to be subject to this crazy provision, and our APA is probably, you know, I don't think it's going to go that far. And it applies if you are acquiring, the U.S. company is acquiring depreciable property from the foreign person. So it applies basically to all outbound payments of deductible payments other than interest. And it also doesn't apply if you're paying a royalty, for example, to the Cayman Islands, because you have a 30% withholding tax, and that's a surrogate. So it only applies in the treaty context if you have an exemption, or maybe a reduced exemption for an outbound payment. So what this means initially, and we'll talk about this, is that all these supply chain planning things which have gone on for years will have to be changed, because if you sell to a related person, you're going to be hit by this, and you may need to sell to some sort of an agent which doesn't create a PE, or to an independent distributor, and maybe other things.
So, Alan, I call it a tariff for related party imports.
Right, and you know, this is the point we had talked about, and I'm not sure this was intentional, but our dear president wanted to impose tariffs, and query whether we ever thought about this one, right?
Yeah, I'm sure he designed it himself.
So, we wanted to end the U.S. segment with this, and just a personal note, I had been the International Tax Counsel years back, and nice to see a number of you for many years. And back in my old role, I was threatening to terminate treaties and would come here and make these threats and all of that. But now, it all worked out okay. Now we have this, and you know, we don't want you to shoot the messenger.
That's right.
That's right. So,
But I presume companies like Apple, you know, are extremely against this, right? There must be a strong lobby from companies like Apple.
absolutely, they're going crazy on this, and they're really they're doing the minimum tax in this one. But you know, recognize from Marty's perspective, if this one is dropped, how are you going to make up the revenue?
The other thing is, what started this tax reform movement 5 or 6 years ago wasn't the groundswell from the population. It was the corporate sector. They wanted to lower the corporate rate, which was out of line with the rest of the world, and they wanted what was back then, they wanted their $1.5 trillion to come back. And so the way, you know, the question about everybody asks, what is Apple winning or losing under this? And I haven't had a chance to try to do the calculations yet, but to me there's 3 big things. One, they're getting a reduction in their rate from 35 to 20, and I think they're fairly profitable, so that's a lot of money. They, what's the other good thing? Oh, they're getting to repatriate that $250 billion of cash they have outside of the United States. So those are 2 things that they have been, and all the business community has been lobbying for at least 6 years. But then, if you just look at the international piece, then they're of course they're very upset. So every company has to weigh. If you look at this bill as a whole, and which ultimately you're going to have to look at it that way, you're going to have to weigh: is the rate reduction and the ability to repatriate offset this wildly wild and very punitive international system?
Marty, you have 2 more slides to go.
I do, and let me just tell you what they're about.
We'll share the slides.
Pardon?
So is your question whether we will share the slides
No,
with
we
the
have
audience?
2 more slides. We
Two
will
more
share,
slides.
but our presentation has 2 more.
Right.
before get
We will
into
share the
this.
slides, of course, with everybody by email after the presentation.
If you want them.
Yeah, and go ahead.
We have 2 more minutes for questions, and then we'll take a break.
Okay. Well, does this also apply to free trade countries like Canada and Mexico?
Oh, yes, absolutely.
So the maquiladoras are all,
against
that is all going to go?
It's nothing to do with trade law. there's no interface. Now, it might violate WTO rules. I don't know enough about that. It certainly was concerned that the prior incarnation, the border adjustable tax would almost certainly violate WTO rules. So the question, I just don't know whether it might. But there's tax people aren't thinking about treaty.
And basically, you know, if we can discuss the next hour, you know, whether this violates trade laws or this, you know, treaty overrides, it's a whole separate topic. Jan?
No, the treaty overrides.
Yeah.
Question with the back.
Yeah, perhaps you mentioned it, but the election to be treated as U.S. trade or business income, is that a yearly choice?
No,
or?
it's irrevocable.
Sorry?
Forever.
It's forever.
Yeah.
Okay.
Last question by Jan.
Sounds a great option then, right?
Jan, you have one last
No,
question?
that's the treaty override that we will address.
Okay.
Yeah, okay.
Well, then, Marty and Dan, many thanks for your very insightful discussion and comments. After the break of 10 minutes, we'll have the Dutch and European perspective on US tax reform, and see you back after 10 minutes.
Welcome back for this second panel, or actually the first panel, because this is the first panel of today, in which we will look more closer to some practical consequences of this pending US tax reform. Stefan Weeghel will be our first speaker. He is a professor at the University of Amsterdam and a global tax policy leader at PricewaterhouseCoopers. He will discuss the US pending tax reform more from an international point of view, and also we'll make a distinction between the old system and the new system, and all the problems that we still have, and tax planning opportunities under the old system, the current system. Jan van der Tooren from Hamelink van der Tooren will speak about the CVB structure, which was currently also in the newspapers, in ordinary newspapers yesterday, and it's now, everybody, not everybody, but a lot of people know now what's going on in a lot of those structures. A lot of US multinationals are using structures like that, or structures who are based on the same concept but then in different states. And Sjoerd Douma, who is a partner and professor at the University of Amsterdam, he will look into the state aid issues of some of the U.S. multinationals, the problems that they have, and one of the problems that's currently pending at the Court of Justice is the Starbucks case. That structure, if you look at that structure and the current proposals, then there will be a lot of different consequences if those proposals will get into law. So he will discuss what will happen when these proposals are approved for all those state aid proceedings. Okay, they will not have in that cases they will not have consequences, but for the structures in general. So that's what we're going to do. Stef, the floor is yours. I think you need this microphone now because we only do it without microphone. But this is a little bit shaky. Yeah.
Good. I hope this works. Good afternoon to all of you. I hope my voice is gonna survive this. I was teaching this morning, in fact, at IBFD. I see some familiar faces, and towards the end of the session, I was losing my voice a little bit. So let's see where we go. Wow, what a shell shock! This bill. I sort of quickly read not the entire bill, but the what was it, 60 or 70 page summary with current provision, proposed change and rationale. In fact, on the airport in Paris last Thursday, and I was forced to do so because I had a call from a journalist from the Wall Street Journal what I thought about it, and I said, well, please send me the bill first and then I'll give you my So I flipped through it and missed the major point, I think, which is the excise tax. Because to me, certainly for non-US multinationals, that's the big shell that was dropped upon us. I was focusing when we were talking on the phone, frankly, on something that Alan did not mention because it was withdrawn from the bill meanwhile, and that was a treaty override for interest payments, which was fascinating, I thought. So here we have the country that has had limitation on benefits and anti-treaty shopping provisions in its model treaty since 1986, probably. I don't think any treaty would pass the Senate Foreign Relations Committee without a limitation on benefits clause. They have been important or included in US treaties meanwhile, with the exception maybe or one or two. And then all of a sudden, you know, after BEPS and after the US did not sign the MLI, we have a treaty override effectively denying treaty benefits unless the parent, the ultimate parent, has similar treaty benefits. But I guess some reason sort of dawned onto the drafters of the bill on Friday already, or on Saturday, so this was taken out of the bill. Getting back to the big picture, if I look at the US system in its shape today, then I would say it has pretty perverse effects. Because we have a system of worldwide taxation, or taxation on worldwide income. We have the highest rate basically anywhere in the world, 35%. So on its face, this would make the US system highly uncompetitive. Of course, the inclusion of foreign income is by design only valid for Subpart F income, for passive income. But then if you combine that system that taxes the income only upon repatriation and Subpart F, the CFC legislation, with a check-the-box system that allows endless deferral, you end up with the 1-point-something trillion, in the Cayman Islands, etc., etc. A very unhealthy system. Everyone, including the government, including US multinationals, would acknowledge that. If you then think, I'll go to the deemed repatriation and to the excise tax in a moment. But if you think of what happened in the last, 4 years, 5 years, 6 years, 7 years, the whole debate leading up to BEPS, the public excitement by NGOs, politicians, that I think Jan may talk about as well. It's also, I will not call it perverse, but there is a paradox in it. So the numbers, the estimates that the OECD gives us on revenue that is shifted, profit that is shifted annually between conservative estimates, 180 and 200 billion per annum, it does not differentiate between the US and the rest of the world. So question how much of that is deferral by US multinationals. And then if you look at the, fast forward to the debates, in fact the debates that we're having right now in the Dutch Parliament, the last few days sort of heated up by Paradise Papers is, it's a lot of criticism to the Dutch government. Why is the Dutch government facilitating tax avoidance by US multinationals? So here we have a bit of a strange system or a strange mechanism going on, where in the US over the past decade an understanding has evolved that yes, we have this 35% rate, yes, we have Subpart F, but yes, we also have endless deferral possibilities, and on balance, I think, I will not say that everyone was comfortable with the system, but there was an understanding. And now we have, in the Dutch context and some other countries, members of parliament that get excited because of this understanding in the US and the fact that, some of the structuring going on in Europe, in the Netherlands in particular, might assist in this deferral that is otherwise condoned in the residence country. It's and none of that, I should not say none, but very little of the income that is deferred for US tax purposes will end up in the coffers of European nations disregarding the state aid investigations for a moment that Sjoerd will be talking about. So an interesting mechanism that, yes, President Bush tried to sort of temporarily, resolve with the, what was the name, the Job Repatriation Act at the time?
Jobs Act.
The Jobs Act.
2004.
Yeah, 2004, which I think brought back to the US much less than was anticipated also at the time. I always tend to think, because there may have been a difference between the amount that was provisioned for in the financial statements and the amount that would have been payable on bringing back the income, because this was a 95% or 90% exclusion, I forgot.
Yeah, the effective rate was 5.75.
Right, and the 5.75 may have been more than some had provisioned for. So the money
they didn't want to pay even 5%.
Right. Yeah. So, so my point here is also in relation to the bill that we have now, that the U.S. system, this combination of factors, has put enormous strain on the international tax system. Lots of the tax planning that is going on can only be explained by the fact of this system. And it's huge because U.S. multinationals, the U.S. economy, is huge. So this has a sincere impact on many structures, on much tax planning that is going on. So, in short, I think it is very healthy to switch from a system of worldwide taxation of worldwide income to a territorial system. That is going to take a lot of the strain out of the system, and it's going to change the dynamics. I mean, for one thing, all the monies that are now sitting, in faraway islands, there is no point in keeping those monies there. And in fact, depending on how this foreign tax credit computation works out, that Ellen was mentioning, you may want to bring it back as quickly as possible, if I understand it correctly. So that's that's not just going to take out, strain out of the system, but it's also going to take out strain out of the public debate. Because once all this money comes back to the US, it's no longer sort of sitting there to expose and say, see, all these billions are on the, offshore, in the offshore location. So that's healthy. But, and I think if, the US wants some advice on base erosion when you have a territorial system, they should turn to the Dutch. Because we have been living with this for ages, a territorial system in which we try to disincentivize taking earnings offshore and then bringing them back exempt under the participation exemption. So we have some relevant experience. But the US, I read in this summary, is aware of this. So there is anti-base erosion rulings abound. And I would think that the excess returns system that Ellen was describing, very interesting. This is my simple reasoning. And by the way, before Ellen told it, when I saw the 80% and the 10%, I grossed it up and arrived at 12.5%, and I thought, gee, this is Ireland. Of course, you can do 10%, and then I guess you would still be 0.5% better off than if you were in Ireland, because you do something there. But I guess the Irish have been saying all along in the past few years, let's onshore all the IP, and once the IP is onshore, maybe with the 12.5% and the 80% credit, that's not such a bad deal. So my hunch would be that that's where the planning will go. Planning is still useful, I guess, because the difference between 20% and 10%, or 12.5% if you will, is still a meaningful difference to many. But it will certainly take out some of the extremes of the planning. If you have endless deferral, or if you have a territorial system without basis protection rules, of course there is an extreme bonus on tax planning. Where do you go? You go to zero. And if you go to zero, and that comes within scope for the European Commission, regardless of the authorized OECD principle and significant people functions, never mind, we just take some of that income, as Sjoerd will talk about. So some of the tension there, and probably some of the incentives to pursue state aid investigations may may get reduced with the excess returns system. Now, and by the way, this all fits perfectly well in BEPS and in the anti-avoidance directives in Europe. So I think systems arbitrage is something of the past, and tax rate arbitrage in the tax competition context is what you go for, and then the 12.5% is not such a bad thing. Although I learned from Ellen that you can mix, so I guess you could also say we go to some countries where the rate is, I don't know, 17, 20, 21, and then make sure that we have another country to shelter some of the income, and then so we'll see how that works. Now, the shell shock, the 20% excise tax. When I finally discovered it in the summary, a pretty horrible thing. A pretty horrible thing, because it basically says, the 20% is not a coincidence. So it basically says, no deduction for cost of goods, etc., etc. So that's very much the border adjustment thing that we have seen before. And then one would say, well, that's not a problem because you can opt out of it. But the opt out of it, first of all, it's weird in the sense that the entity that opts out, I guess technically it would be an entity opting in. The foreign affiliate would opt in and say, I'll be deemed to be engaged in a trade or business in the US. I have ECI, effectively connected income, and therefore my US affiliate is off the hook with the excise tax. So what is that? My first thought before I spoke with Granwell was, well, that's all fine. Now I'll be deemed to be engaged in a trade or business, so deemed to have a branch in the US for US federal tax purposes. Not a problem, because of course for income tax treaty purposes, this is not a permanent establishment under Article 5, so therefore I check the box, I make the election, but it's not going to harm me because I'm protected by the treaty, residence taxation only. But I understand it's a bit more subtle than that. It's not an outright treaty override. In fact, the bill probably does not talk about tax treaties here, but it's implied in the bill that this checking the box to be engaged in a trade or business means that for treaty purposes you elect to have a permanent establishment in the US. Now, okay, that's step one. Step two, what is then the income that you're going to attribute to this permanent establishment in the US? So here we have a foreign multinational that does not have a branch, no physical presence in the US. The only thing it does is it renders services to the US affiliate and it sells goods to the US affiliate. And is deemed to have a permanent establishment. But then, if we apply the authorized OECD approach, I would say that the profit attributable to that P is zero, because there is nothing going on in the P. But that's not quite the intention of the drafters of the bill. So, just a couple of remarks. One is, if you're forced with an excise tax, in your back, if you're forced to make this election, is that some sort of treaty override, or and what does it mean in fact for treaty purposes if you make an election that doesn't make sense from the perspective of the income tax treaty? Second, if you then compute the income, it's got nothing to do with the OECD principles to which the US is. I say that very cautiously. So. If it's an implicit treaty override, there's the later in time rule, govern this situation, so it's an override anyway, nothing we can do about it. Then the foreign tax credit. I have no answers to these questions. I just raised the questions, but I think it's weird. It doesn't fit in the OECD construct.
One point just on the election, as you were talking, recollect that in our treaties, or most of them, you have an election to be treated as a dangerous business for rental property. So, not what they thought about that.
Yeah. Okay. Yeah.
And the income, is that only the income that that is raised on sales to America, or is it all of the income if it is deemed to be a permanent establishment?
No, it's the. I think it's the U.S.
Only the U.S.
Yeah, we're not unreasonable.
It wouldn't be the first time.
I was going to say I'm not authorized to respond to that question, but Ellen picked that up already, so that's good. Then the foreign tax credit. Also very interesting, a novel concept, I would say, because normally you would say in the US system, the way I understand it, and certainly got it served to me when I did the tax LLM at NYU a while ago, was that the foreign tax credit is for US resident taxpayers in respect of foreign source income. So now we get a foreign taxpayer, that's a foreign taxpayer by election, that then has income that under treaty rules certainly is not attributable to a term establishment in the US, but nevertheless will be allowed a tax credit for foreign tax that again it's got nothing to do with, so it's, you know, it makes my mind, it brings my mind in serious trouble. I have no idea how, perhaps, you know, Ellen, later on if you wish to expand on that, but I find that challenging as well. So,
it fits the Trump's politics. We don't want any facts.
Or law. Or alternative facts.
I don't know.
It's all fake news.
Let me just
fake
not,
tax.
yeah, let me just not use up, you know, all the time on this, but just a couple of remarks in the bigger scheme of things. So one is, if you see legislative proposals in continental Europe, if you see you know, themes coming out of the OECD, the European institutions, there is quite often a technical discussion also about the question whether there is discrimination, you know, discrimination against non-residents, etc., etc. You won't find any non-discrimination language in this bill, but it does say time and again, we have to level the playing field. And the level the playing field means, in this context, we are looking after our own tax base for US multinationals, making sure that US business is not, you know, taken offshore, and therefore we have interest deduction limitation rules, therefore we have this, you know, excess profit, etc., etc. And then it says, but in order to level the playing field, i.e. the foreign multinational should not be treated better than the US multinational, will also apply to the foreigners. That's, you know, the thinking going on behind this. Now, Peter, did you say America first?
No, hold on a second.
Hold on a second. Okay. That was a brilliant little video, by the way. So we'll see how this plays out. One thing that came to mind when I read about this excise tax, apart from the fact that I thought it was pretty horrible, but if I then look at what's happening elsewhere in the world, also in Europe. First of all, we had the state aid investigations that Sjoerd will be talking about, big numbers, as we all know. I think the US, the position of the US, of the Treasury with the white paper and the visits that Secretary Lew paid to Brussels, the message was, this is something that you Europeans invented. You're not going to tax US profits and certainly not going to, you know, do this at the expense of the US taxpayer. The second is recently with the discussion around the digital economy with you know, the OECD tinkering with the idea of a significant economic presence, digital presence, the Estonian presidency in the EU toying with different ideas, and all of a sudden, bang, 4 finance ministers in Europe, France, Germany, Spain, Italy, saying this is not going fast enough. We really love the excise tax that India has you know, introduced a while ago. So if you are a digital company and you generate revenue in our country, we'll just tax the revenue with 6%. I think the levy is in India. I have no idea whether the drafters of this bill had this in mind, but if you want to create some leverage vis-à-vis Europe, it's not a bad idea to stick an excise tax in your bill and then see, you know, what the dynamics will be in a discussion across the ocean. So that's just a couple of ideas. I'm sure that quite a bit of what I said relates to something that was amended today or will be amended tomorrow, but this is it.
As a result of your comments.
Actually, I do not know if there is somebody with a question or remark after this. No, after then Jan, you can come up and we go further with the CV structure and all everything surrounding it.
Yes, the mess surrounding that, because that is for sure the case. Okay, you already put the slide on the political debate. Should I go back with it, or?
I don't know if I know how it works.
Well, you know,
If you press it forward, it goes back.
forward goes back. No. Backward goes backwards. Yeah. Yeah. Yes, so good afternoon. My kind of idea was today to talk a bit about US and the Dutch relations. And the US tax reform obviously has an impact on tax planning, which is taking place today. I just come today with a bit of a message also from the business community that I'm aware of. And I will talk a bit indeed on the CVB structure, which since I think yesterday and today has become extremely kind of popular, and I think Dennis, you mentioned now everybody knows about it. I think the really problem I will discuss about is that people don't know about it at all, but they make all sort of statements, and that is really upsetting. It's upsetting. Sorry, they know that it exists, and now I think it would be wonderful if they really know what it means. And I'm looking at the climate and the media. The Dutch tax environment, I think also with our new government, we see that there's apparently a stronger focus on the investment climate. It has always been on the agenda, but it's definitely, as you all know, somewhat hindered by the left wing. Not so much because the left parties don't want investments, but they have a different view on how that should be achieved. Now, the competitiveness of the Netherlands with the new government, the reduction to 21% finally in 2021, I think the question is it low enough? Stef, you already mentioned Ireland and I think even the UK then. Probably it's not, but at least it's a sign, and looking at the US tax rate, it probably is not enough. Then we have the abolishment of our dividend tax, which is probably also going to be in the newspapers because of the public debate about how that decision was taken, probably driven by two boardrooms with an interest there. And the introduction of withholding tax on interest and royalties, which probably, I don't think there's much known about that, but probably to take away our image as a conduit country, which I think is a good thing, and hoping that it only affects really conduits without substance, which will be making payments to tax haven countries. Now, what about this CVB structure? And I have to tell you, there are some LLM students in the room, and for that reason, so that's not for you, but for the students also, just to, what do we talk about? And I think it's important, it's today, and it's important because I think it's also important that we try to bring across the message more to the public, the message that is now circulating. Now, in essence, the CVB structure is a structure where there's a reversed hybrid CV. The CV from a US perspective, I'm now talking about the US angle to it, from a US tax perspective, the CV is set up as a corporation, and there's IP transferred to the CV. The CV is then licensing and I'm going short, and Ellen is going to criticize me if I want to be kind of explaining you this in detail, but from US perspective what happens, the CV is going to license the IP within the group, and it's going to generate royalties, and the royalties from a US perspective are treated as received by a foreign corporation, by the CV, and because the foreign corporation receiving royalties is not subject to the US CFC legislation because the royalties are treated as active income. There's no pickup of taxation in the US. So this is the US perspective. Now, the Dutch perspective, as probably most of you know, we can set up the CV as a transparent vehicle. The transparency has as a consequence that not the CV is the owner of the IP, but the partner, i.e. the US corporation owning the CV, or is the limited partner in the CV. From a Dutch perspective, therefore, means that the royalties that the Dutch company, that the BV receives, is paid on to a foreign US entity. So there's only a small margin in the Netherlands today, and no taxation of the royalties. Now, what it obviously creates, it is a situation where there's no taxation besides the small margin in the Netherlands. There's no taxation in the Netherlands on the royalties, but there's no taxation in the US either. So you have a basically, we'll call it stateless income accumulated in the CV. Now, the debate we see now is that there is in the Paradise Papers there's a company which is a US company which is using the CVBV structure, and the media is overreacting in my view tremendously, stating that and that is a very important part. The newspapers will tell you that what a shame, this CV is not paying tax and there's no, and the US government doesn't know this. So it's basically hiding income from the US doesn't know this, and how terrible is it that the Netherlands is cooperating in that type of structure. But this is obviously not the case. The CV and like Stef was saying, this is the whole US system which is based on that type of tax planning, and it's totally nothing to do with the Netherlands. You can do this in Luxembourg, you can do it in Ireland, you can do it in other countries. And yes, the CV is often used because there's also economic activities in the BV in the Netherlands. So this is more the fact that we are an interesting country from an economic substance perspective for the US. So this is really something which I believe should be mentioned here today, because it is important that this is not correct, and the media will hit on it, and political parties are hitting on it. I can see our left-wing parties talking about this, how terrible it is that we are facilitating these type of structures. And again, it is what the US wishes, is what the US knows, and there's, from our perspective, I would say nothing wrong with it, but probably it is in the view of many. And then I think there's also in this debate a bit about the ethics of tax planning. I think it is important to mention that from a European and from a Dutch perspective, tax planning has become even a word which is almost not acceptable any longer. You do not do tax planning because it's paying a fair amount of taxes. In the US, this is different, and Alan, correct me if I'm wrong. In the US, I think if you talk to US lawyers, they will tell you, if I can, and there's even been research polls being made within the, I think it was the Google shareholders, where they, I think like 90% were saying like, if I can save $1 of tax, you as a company should be saving $1 of tax. So that is a totally different attitude towards tax planning.
Right. If I could just make 2 points here. First of all, on the BBCV structure, we have the whole, the recognition of that as lacking substance and depth. And literally, I attended a program in Washington a number of months ago where the chair of Working Party 6, Mike McDonald, who now is an EY, was going through the BBCV structure. He was literally saying how it works. So clearly, government knows. But secondly, on the ethics, I think the bigger issue is on this is between appropriate tax planning and tax planning which may evade the foreign system. And if that type of planning occurs in the United States, monies are transmitted, that's a crime. So, and that has been really raised in the failure to prevent UK legislation, which is another topic. But this whole area of the ethics is, I think, the next area where there's going to be a lot of
discussion, and what you're basically saying is that this, let's say the European kind of view or attitude is also taken on in the US.
Because you will, from the US point of view, need to examine the conduct under the prison of US criminal law.
Okay, criminal law is kind of far away from, yeah, okay.
But you've got a president that says, I'm smarter than you because I don't pay any tax. So how can this be an issue?
So and then obviously there's complaints in the newspapers about the CV structure, and there's even European Parliament. I understood there's talk about that really measures should be taken against this type of structures, and obviously we all know measures are being taken. So there's not so much of a panic to be made about this. So now some of the Dutch U.S. tax considerations. It's obvious probably to you that the business community today, if you talk to U.S. Head of tax abuse corporations, they are definitely in a waiting mode. I'm talking about kind of the Dutch-based heads of tax abuse corporations. They're in a waiting mode, and they are in a waiting mode. But for this type of structures, they are obviously facing the introduction of our A10-2, which is affecting hybrid structures with third-party countries like the US, and it will mean effectively that the structure no longer can work, because the DV will not be able to deduct, as of 2020, the royalties paid to the CV, because there's no taxation at the recipient, which from a Dutch perspective is the US company. And then the ATAT specifically addresses also reverse hybrid, which is the CV, which it's a corporation from the third-party country's perspective and transparent from a Dutch perspective. And then the rule is that this in this case CV would become taxable as an entity in the Netherlands. So that is as of 2022. So no more CVB structures, clearly, and let's face it, I hear some different sounds here in the audience, but my general experience is that companies in the US don't consider setting up these structures anymore. That was like the case like 2 years ago. It still works, but I haven't seen it being set up.
And companies are moving away from
Yes, yes. So then, what are people now suggesting? And this is what Stef was referring to, onshoring the IP. I have made a slide which probably is a little bit naive, because it suggests that what we do from a Dutch perspective, we make this transparency fee a non-transparency fee, which we call an open CV, which would then make it all of a sudden a taxpayer, which would then start with a stepped up value, IP value, would be in a position to depreciate the IP, which will then obviously create a lower tax rate effectively. But it would require, in my view, looking at today's view of also the Dutch tax authorities, that the so-called DEMPI functions, meaning that the actual development, enhancement, maintenance, production and exploitation should really be carried out here in the Netherlands. And then obviously the question is, well, is that going to be attractive within the effective tax rate that you will arrive at? You could actually transfer the IP straightforward, or maybe move the CV to Ireland, UK, but even maybe to the US, depending on how that would work out and what the specifics of the structure.
Well, interestingly, as you're talking, just if you were, I think, if you were to do this post 2018, so we're not under the deferral system and it's active IP, then the income, I think, could be viewed as protected under the territorial system, subject to the minimum tax, and you could bring it back to the U.S.
free of tax. As an
I think
example.
that may be
Yeah.
possible, because you would have 100% dividend.
And then essentially look at the tax rate in the country, for a country, which then brings Ireland in a better position. But having said that, I also, luckily enough, come across quite a number of companies where taxation is not the leading, it's not the driver. And I think these are the companies we're looking for in the Netherlands, I guess, companies which are looking at our technical universities and the logistics that we have here in the Netherlands. So that is probably the type of companies we're looking at for the future. And I think it's my kind of take on today's relationship with the US and attention for.
And I think it also goes to the point that in today's world, from the US point of view, you want substance, no double deductions, no savings.
Yes. Yeah. So we're getting in a way to a fairer world, which at the end of the day, and it was interesting when we had a presentation of Raphael and Russo, I think we were there in Vienna, where at the end of the day, because BEPS is talking about the whole BEPS project, nobody indeed talks about the fact that it's probably 80% driven by US companies, US tax planning. But the other statement in the whole BEPS project at the very beginning was, we are looking at, and we are not looking at fighting fair tax competition. And fair tax competition, as such, you can also raise the question, what does that mean? And what it now today means is lowering your corporate tax rate. And that is the competition which is going on, which is probably what we will see, and then generally refer to as the race to the bottom. Probably that's the term.
With the big exception that the US doesn't have a VAT, so they need the corporate income tax revenue, while Europe has a VAT, if that's the main money rate.
Yes. Yeah, that's I agree. Also raised the question about local taxes, state tax revenue, because I guess the state tax is not within the 20%, obviously. But yeah, I definitely.
Okay, thank you. Questions, remarks? No? Then we can go further with the state aid. Or you have to.
Just on tax people, we like to go into the technical details of stuff. We love that. But I'm getting a bit more worried about the firestorms in the media. And I don't think it does not go away from itself. I mean, it's here now for a couple of years. And I think the public debate is pretty one-sided. And the NGOs seem to be doing a much better job in being vocal and getting their point across than business. Do you have any ideas or suggestions how we can turn it around? Just, I'm emphasizing the word we here.
Yeah, I think this is a very it's actually over lunch in the office we often we have red faces. I mean I get to a point where I don't even open the links sent by my colleagues about publications because it really I never thought that I would get at that point. Really irritates. And indeed the question is how can you bring across? I did maybe that's a bit of a long answer to your question. We have within the Hague office, we have a lobby, one of the important lobby firms, and I said to them, I won't like to give you a presentation about what really taxation and all the nonsense being published in the newspapers, what's wrong about it. Talking about a Portuguese high net worth individual setting up a holding company in the Netherlands and then taking away all the taxation of the profits on the supermarket that he owns, that type of publications. And then he said, well, that's interesting, it's fine. So we had a large gathering and I tried to, in what we call a Jippe Janneke taal, so that's our easy, trying to explain to them. And then after like 10 minutes they said, I see you try to do your best. We lost you already. What is like dividend, withholding tax, exempt? So, and then I said, this is basic, and then it's you try to, if you have a public subject, you try to bring it across to the bigger public, you should be aware that these type of talk, you cannot, it's technical talk. So my view is that I try to explain our secretaries, like, can I explain to you what's happening? And then they looked at me like after 10 minutes, same story. So I'm sure not the guy, this is not the idea at all. But you know, you need someone, and then they said to me, a lot of guys said to me, you know, you should talk just like what you want to bring across, you should tell them in very simple words. Lie if you need, because it's not about telling the truth. That's not the public debate. It's just about telling, you know, telling nonsense. It brings across your message, and then it stops for me. You know, that's not the way I'm raised. I cannot do that. But sometimes it looks like, how can you bring across technical, difficult issues? Talking about the CVB structure, like, how would you explain that?
Look at the U.S. system now.
Yeah.
Yeah, well, you could say like CVB structure, the US is aware that the income is actually not taxed, it's not supposed to be taxed, one day it will be taxed, and that's fine, that's what the US believes is fine. Maybe that's kind of the way, but it's a very good question, and I have the same.
Okay. I was going to make one observation.
Yeah.
It's not an answer, but everyone wonders satellite television, I can watch British TV, and at the same time I'm watching American television, and the outrage over these leaks of the Paradise Papers and the Apple back a few years ago is much greater in Europe than it is in the United States. It's front page coverage, just yesterday, front page coverage in the Irish Times, and it's just, I don't know exactly why that is. I'm just making that observation that it is much. You would lead the news every night for weeks back a few years ago, and in the U.S. it might get a mention, you know, at the end of the program, once a month. You know, it's just very different.
Okay, thank you. Actually, before you start, Sjoerd, what we can do in this discussion, and to give an answer to your question as the Amsterdam Centre for Tax Law, is to organize a roundtable with journalists. NRC is just around the corner, so come together and let's have some speakers. The professors will make sure that you're not lying, nobody's lying, so that everybody tells the truth, and we'll come back on that. In the meantime, I'm searching for your slides. You know, you do not see that. You still see it now, but Sjoerd can maybe say something about this. Also, this new structure, because that new example that you gave. Because one of the problems also with that example is the state aid issue. And when I look at it, the state aid issue at the end is now turning into an allocation issue. A transfer pricing issue, and you have completely the same allocation problems in that structure than the old structure. Especially you look at the Starbucks case, but also when you read the Amazon case, but it's not published yet. But if you read that case, then you will see that all these CVBs could solve potential problems. Okay. This one. Yeah. Sorry, I have to correct myself a little bit, because I said you're our partner, and I never mentioned your firm, because you can be a partner of a woman or a man or whatever, you know.
We're in the Netherlands. We are in the Netherlands, right?
But the firm is called Lubbers, Boer and Douma, but most important now today is with his head of the University of Amsterdam.
Thanks, Dennis. So the last presentation, I really did my best on the slides, so I hope you like them in the correct University of Amsterdam format. US tax reform, impact on EU state aid proceedings. Because, well, I think there might be an impact, perhaps on the case which are currently pending, but perhaps also on future cases. So let's try to get to a better understanding of that. Well, 4 points on the agenda, as you can see. A recap of the pending state aid cases involving US multinationals. Which were the cases again? Relevant aspects of US tax reform. What parts of Alan's presentation and Marty's presentation are relevant, potentially relevant for the state aid investigations, possible current and future impact, and an outlook. So if we then go to the cases which are pending at the court level or at the European Commission level still, I just copied a number of pictures from the decision, the formal decision of the European Commission. This is copied directly from the decision of the European Commission in the Starbucks case. And what you see here is, in fact, a type of CVD structure which Jan described. Only in this picture, it is about a limited partnership under UK law in the end. So what is the problem of the European Commission in this case? You may very well remember this. BV is paying royalties to a hybrid entity. This hybrid entity is taxable nowhere, so a deduction in the Netherlands and no pickup anywhere. What the main point of the European Commission is how can you pay deductible royalties to an empty entity, an empty limited partnership? How can you attribute IP and IP income to an entity which has no employees, which has no address, which has no functions whatsoever? That cannot be, that's not possible, the European Commission says. So the royalty would not have been paid between independent parties. So that means no deduction at BV level. The royalty should not be deductible. By making it deductible, by allowing a deduction in the Netherlands, the Dutch tax inspector has granted a state aid to the Dutch BV, because in independent situations this royalty would not have been paid. The Amazon case is basically very similar. It is not about the Netherlands, it is about Luxembourg. Luxembourg entity, a box, is paying a royalty to a hybrid entity, the triangle in the structure. So a deduction and no pickup or no full pickup in the US. And if you read the press release, because I have not yet, Dennis, unlike you perhaps, not yet read the full decision of the Commission, one of the main points the Commission seems to be making is that the deduction in Luxembourg is not the same as the pickup in the United States. There is a big discrepancy. And how can that be under at arm's length rules? And again, how can you attribute that income to a hybrid entity where nothing happens? So a correction in Luxembourg, the tax inspector in Luxembourg should not have allowed this deduction, or at least not as a whole. Apple, in fact, again, a variation on the same theme. Only here we are not speaking about a hybrid entity, we are speaking about an entity which is resident nowhere, which is not resident in Ireland, which is not resident in the United States, but which does have a presence in Ireland, has activities in Ireland. And again, the question is, can we attribute income to the permanent establishment which Apple has, the non-resident Apple group company has in Ireland? And again, this evolves around IP. Apple maintains that IP rights are sitting in the entity belonging to the Apple group, which is not resident in Ireland, and that on that ground a lot of income should not be attributed to the Irish parent establishment. So again, this is about attribution of remuneration for IP. Commission, again, just like in Starbucks, just like in Amazon, says how can you attribute income to an empty head office, to an empty entity where no one is really taking care of the IP. So I'm just giving the view of the Commission.
Okay. Would the whole issue be resolved then if they were populated with some employees? Because
so your question is, would the whole situation be different if there would in fact be employees, etc., risks, functions in those entities? I think under the reason of the Commission, the answer would be yes, should be yes. But what in fact the problem is of course the US system. And that's where I want to go to, is to US tax reform, because that's the topic of today's presentation.
Sorry, because I have, let's say, some background knowledge on that because I work for Apple. Is this the distribution structure or the IP structure?
No, the IP, I was talking about the IP structure. Yeah. Yeah.
Because there are employees in the distribution structure.
Yeah, but in at least
an assembly plant in Boer.
Yeah. So you have to make a distinction between the activity in Ireland, which is under Irish law a branch or a permanent establishment, and the head office which owns that permanent establishment. And according to the Commission, the European Commission, that head office is empty. And because it is empty, it cannot earn profits. That's what the Commission is saying. But the conclusion the Commission is drawing from that is that those profits should therefore be taxed in Cork, in Ireland. But according to other forces, it's the wrong conclusion. And because the income is really generated by the activity in California, by the bright people who are designing all the stuff.
Then the cost
That's a discussion.
Then the cost agreement is wrong.
Then the cost agreement, and I'm coming to that in a moment. McDonald's last case of a US multinational, which has drawn a lot of attention, also again about IP. The idea is that a company in Luxembourg owns IP rights, but attributes those IP rights to a permanent establishment, you could say, or at least an activity in the United States. The United States says, well, and of course the royalties paid on those IP rights, Luxembourg attributes to the US branch. So Luxembourg will grant an exemption, does grant under the ruling an exemption under the tax treaty for those rulings, for those royalties. So those royalties are exempt in Luxembourg, but they are not taxable in the United States either, because they don't constitute effectively connected income to the United States, and there is no active trade or business in the United States. So again, those royalties are in the end taxable nowhere. And the Commission says, well, if I just read the tax treaty, this should not constitute under tax treaty law a permanent establishment. So Luxembourg was wrong to exempt those royalties, was wrong to exempt PE income in this particular case. So what are then the common themes in all of those cases? Well, the common themes is that all of those cases seem to evolve around a mismatch in the allocation of IP and the remuneration thereof, and that has everything to do with the US tax system as explained by Stef a few minutes ago, where it is acceptable that you, let's say, offshore IP and have a large part of the profits of the group outside of the US. The Commission, in the end as well, and that's your point, Peter, about the cost contribution agreement, the Commission says, well, in the end, there can be only one at arm's length principle, at least that's what they seem to be saying. There's one at arm's length principle, and therefore there can be no mismatches in the application of that principle. So how can it be that under US law, certain remuneration is distributed to an entity which is totally empty, under the at arm's length principle? That is wrong. But, and then I go to some interesting remarks in the Apple decision. But of course, the companies are free. Apple in this case is free to correct it. If you just read this paragraph from the decision, this is the part of the decision where the Commission is talking about recovery of the illegal state aid. The trading profits to be subjected to taxation in Ireland may be adjusted, the Commission says, following an effective restatement of the statutory accounts or tax returns of the Apple Group companies, following corresponding payments and adjustments to the statutory accounts or other Apple Group companies in line with the general rules in Ireland, to retroactive restatement of financial accounts or tax returns, and provided Apple is able to sufficiently evidence any effective liability towards either Apple Inc. or other Apple Group companies in other jurisdictions. So the Commission seems to be saying, well, if you, Apple, if you believe that the attribution to the head office, which I was speaking a few minutes ago, is in fact wrong, and that the profit should have been attributed to other group companies, perhaps to the US, that's fine. You can perhaps restate the statutory accounts, or you can restate your tax return. And then the recovery might not amount to the 13 billion euros, but might be less. And in paragraph 450, the Commission again states that such a restatement could also result from a retroactive modification of the CSA, what Peter was referring to, or the marketing services agreement. And well, the question I would like to raise today, and I also don't have the answers, because this is very recent, but what could US tax reform mean for those statements? What does it mean for the cases which are currently pending, and what does it mean for possible future cases of state aid in the European Union? We have to recapitulate some of the things Alan has also described. The proposed section 4004, repatriation of trapped earnings. I'm just repeating exactly what Alan has said, but US shareholders owning at least 10% of the specified foreign corporation are required to include in the income accumulated earnings and profits for tax years after 1986. That's an obligation, I think. Two rates. Cash or cash equivalent is untaxed at 12%, and let's say more active income is taxed at 5%. That is, let's say, one rule which is, I think, relevant for the discussion, because what does this mean? This has retroactive application. Does this mean that the income which the European Commission is targeting, for example in the Apple decision, is now retroactively, you could perhaps say, well, reallocated to the United States, so that in fact the income, the tax return is modified, as meant in paragraph 449 and 450 of the Apple decision, which we just saw. Question. So that is, I think, relevant for the cases which are currently pending. There may be also relevant.
Can I ask a question?
Sure, of course you can ask a question.
Because section 404 is a deemed repatriation, right? You're deemed to have distributed your earnings and profits as per, what is it, November 2nd or December 31st, right? So, but that is not a retroactive fact. You, at that moment, you're deemed to have distributed. So I don't know. I don't see the retroactiveness in that. Only the fact that the ESP is built up over the years.
Well, perhaps the retroactive effect is that it concerns profits from the past,
yeah,
and also profits which have been included in the European Commission's decision.
Yes, but it's always it's a distribution itself for which you get a credit for the underlying tax,
Yeah.
but it doesn't specifically tax the profits.
Yeah, but what if you say, well, I accept this 12%, but you know what I'm going to do? I'm just going to pay it out to the United States, just like the Commission has suggested. No recovery.
Well,
or is it too simple? Perhaps too simple.
That's actually the shareholder paying, right? It's not the entity paying.
Which entity is paying?
The shareholder that's actually receiving
The US shareholder, yes.
Different legal entity.
Yeah, but okay. Well, but the idea of the Commission report is that the profits have been reported in the wrong entity. And can you perhaps correct that? And that's what the Commission is suggesting. How can you correct that? And my question is, can US tax reform perhaps be helpful in that correction?
If I could just make several comments. What you're really talking about is a reallocation of the profits to another entity, 8.1, in terms of their cost sharing agreement and their other arrangements. Secondly, under our 482 principle, isn't that would be the case here? You can't reduce authority to, you can only increase the amount which this would be doing. So, and I think going to Mikhail's point, this reallocation would have to have been done within the period of between 86 and November or December, otherwise it doesn't come within the reallocation. So I think the basic point is under U.S. law, would the IRS accept a reallocation where the taxpayer had said that this was appropriate planning from the past? And I think that could raise a lot of issues on this.
Well, another point which is perhaps relevant is the is the foreign tax credit. We spoke about it, I think, briefly before the break. The recovery of state aid. I mean, state aid recovery has taken place or should take place. You know perhaps that the Commission has started an infringement proceeding against Ireland for not recovering, at least not in the way the Commission would like to see. Let's say that a company, a US company, pays back the unlawful aid in the past. Combines that, of course, with the mandatory taxation in the United States as well. Hey, I can just as well pay out a dividend and get in the US a tax credit for the recovered state aid.
You also have the issue that when you get credits, if the local tax is paid.
Well, the local tax has been paid. The local tax is the state aid.
Yeah, the question is whether state aid is a tax. The payment is a tax.
Well, I think, well, at least to US tax lawyers I speak to, they indeed seem to be of the view that it is a tax because it is just a retrospective tax assessment, it's nothing less. And, well, would US tax reform not make it easier for US companies, well, to indeed repatriate those dividends, those profits, with a tax credit for the state aid?
One way to think to test your line of reasoning is, what if the repatriation rate is 0.1%? And what if the repatriation rate is 35%?
Up the there, Dave.
Does that change your
Yeah, so can you repeat your question? Yeah,
one way to think about your approach, which is fascinating, is what if because the repatriation rate is we look at it as just an arbitrary number. So what if the rate was 0.1% or 0? And what if it was 35%? How would that change your reasoning about its effect on the EU?
Well, my reasoning was more, I think, from a practical perspective, that the tax rate is now so high that it's almost prohibitive for a US multinational to do repatriation. If the tax rate goes down, the 12%, it's a mandatory tax rate even, you can, why don't you might just as well pay out the profits to the United States, right? It has been taxed already. But while you do that, can you not credit the state aid recovery against the US taxation?
You can.
That's my question.
You can.
Yeah. And would that not take out the sting of the state aid investigations for a large part? Just trying to connect European Union law to US tax reform, because that's my hobby. So the foreign high returns, yeah, from an economic perspective. The foreign high returns, section 4301. I'm not sure, Ellen, maybe you got to this point, but I borrowed this partly from your slide, so we will. This is a new provision aimed against shifting income out of the US by allocating it to intangible property held by low or no tax foreign subsidiaries by having some kind of mandatory pickup, a rule which taxes income earned by foreign subsidiaries above a certain routine level. That is then taxable in the United States for 50%. Yeah, yeah. You did speak about it. think.
No, I did, because the high return applies to any income other than a return on certain tangible property,
Yeah.
the deemed modest return deduction.
Yeah.
Anything else is covered.
But it would apply to IP in low tax countries.
For sure.
Exactly. And the stated investigations which we have been discussing in this presentation all concern IP structures. So is the chance that those IP structures will continue to exist in the future? Will we see many state aid investigations going forward? Perhaps not, because those structures will not exist anymore. And that's also, I think, an effect of US tax reform directly on the application of EU state aid.
I think it's directly impacting that, as you're saying, because the US wants to get 50% times the 20% rate minus the 8%.
Yeah. What we do have to be careful about is, I think, the European Commission thinks there is one at arm's length principle, and if you have, let's say, a hard and fast rule like the US is proposing, this one, 43001, that might not necessarily be in line with the arm's length principle either. And so you might still have conflict between such a provision and the at arm's length principle, which could potentially create state aid issues in the EU. Okay, so we have discussed the effect of US tax reform on pending cases, future cases, and we have discussed the foreign tax credit in the US. We don't have all the answers yet, but I think it is a fascinating topic to connect EU law with US tax reform. And we need to do, of course, more legal research on that. And where do we do that? At Amsterdam Law School. Thanks very much.
I have a question actually to all panel members. I think
Now we give
the US colleagues. What is the chance that actually this will become law?
Well, I'm glad you asked that question because we have two slides. Which one is going to cover?
Can we get my slides
back?
Bring them back. Go forward. Just a preliminary response is, when it was revenue neutral, before they approved a $1.5 trillion extent, I put the odds at close to zero. Find it humorous and find it humorous.
Just keep going.
This is the one.
Yeah. Thank you very much.
This one?
No, we're going the other way.
What's happening?
So, and then, so here are, rather than giving you a flat percentage, I'll let you think for yourself. Okay? What are the arguments for this passing? And we've hinted and gone over these a little bit before. One is the absolute political necessity. So you hear the Republicans say, this is going to pass because we have to pass it. That is the reasoning behind that bullet point. We've gotten through reconciliation, so that's very good. We only need 50 senators, and we have 52 Republicans, so that's good. Now we have $1.5 trillion to spend. You should be able to, any politician should be able to make good out of that. And that when, if you've never seen creative accounting until you've been on Capitol Hill, they're going to stretch that 1.5 trillion in all different types of ways. That is another seminar to talk about that. And then it's not, we've sort of implied through all of this that only Republicans would vote for this bill, but just in the upcoming 2018 election, there are 6 Democratic senators up for re-election, and they are in states that Trump won handily. And so there is a conservative wing of the Democratic Party that might cross over to this bill. So Democrats may come on board. We had 2 quarters of more than 3% economic growth. So right in the immediate moment, we're feeling comfortable that maybe we will have this growth, and the projection that I showed you, the arrow going up, maybe that's too steep, and maybe our debt is not that bad. And then very importantly, the bill is going to move, even though it's a pro-business bill right now, even though on the international side it isn't, Overall, it's pro-business, and overall, it does help the wealthy more than the middle class. The bill will move more toward the middle class and less benefits for business and the wealthy. And I think that will make it more sellable. So the Senate will, and the Senate is certainly making noises about taxing the wealthy and the corporations more. And the president is certainly, in fact, they just was being rude and using my iPhone. The president said, I can't live with the House bill because it doesn't provide enough relief for the middle class. So
Is that from China?
he couldn't tweet it because they don't have Twitter in China.
Censored.
He sent it through North Korea, right? Anyway, you will see news reports and sound bites from politicians and you go, wow, it really sounds like it's going to pass. And then you can make a convincing counter argument. The Republicans, when they had Obama, they didn't really have to rule because they could say anything and nothing was ever going to happen because you could veto anything. And so they got very overconfident in their ability to do things because these members of Congress, half of them have never been in the majority. They've been, it's 8 years of Obama. And so they're young, they don't understand, they've never actually had responsibility. So they made popular statements like we're going to have a top rate, individual rate of 25%, and it never comes true. So they've overpromised, and the disappointment among their own supporters, as with their failure to repeal the Obamacare, is very great. Impossible rushing. At this point, if we could go back in a time machine to 1985, where we are in the political process right now with the Ways and Means Committee having not even voted on it yet, that would be 13 months before President Reagan signed the bill. It took 13 months. So if we just said the past predicts the future, it'll take 13 months to pass this bill under 1986 conditions. And the Republicans are promising to do it in something less than 13 weeks, which is, and the other point I'll make is people who are closer to, who know the Hill and been involved in legislation are much less optimistic than folks who are not technically oriented. So that's really
Martin,
yes.
I think we have to stop because they want to use this room.
Oh, well, that's...
Library's open.
Within 5 minutes.
5 minutes.
Yeah.
Okay. You want me to stop?
Yeah.
I can understand that. So I'll only go to the bottom highlighted, italicized line, which is the big picture is this is a political battle between traditional Republican values, which is tax cuts for corporations and wealthy, versus the new populism and their promise to provide tax cuts to the middle class. And we only have 1.5 trillion to spend, so every time you say you want something, you got to give something back on the other side.
Thank you. We were not aware that they need this room after this, but I saw some people there getting very nervous. Yeah, we can stay here, but we have a drink. Thanks, panel, for all the insights. I promise you that if this will be approved, that we will organize another conference. That might never be happened, and then our US speakers can come back then to Amsterdam. Thank you for being here. So we will see if we have another conference in some months. We will have a drink. I do not know if it is here or downstairs. I assume that it is downstairs. And hope to see you soon. Thank you.